Good morning. Hope everybody's doing well for another weekend, another Saturday, and continual Groundhog Day. Today, we're going to hit a little bit kind of the continuation of what we've been talking about. Started off with kind of the banking system and the Federal Reserve System in particular. Then we kind of went to some longer term trends and looked at that. Last week, we talked about sort of the short and near term views. So again, what I'm thinking is sort of deflationary forces right now, contraction, but because of what the Federal Reserve is doing, we'll have some inflationary environments. So, and today we're going to just talk a little bit about the inflationary part. Long term, and specifically what I want to look at is kind of introduce an asset class. I haven't started using this at all, even for clients, for personal accounts, anything. But been following it for a long time and starting to see a lot of smart people talking about it, and that's Bitcoin, cryptocurrencies. So I just wanted to kind of introduce that asset class a little bit, and also some other classes too. So let me share my screen here so get the presentation going. Now, a little bit of this will be just a recap of what we talked about, just in case there's people who haven't been on the calls before, or just as a refresher. It's always good just to get the refreshers. So again, today is kind of the end effect, the post-deflation in investing environment. And then obviously the real reason I did this is just to take questions from people. That's the biggest thing. So again, the big trend that I see in the near term, I call it the four horsemen. The first one is just we had a high stock market valuation even before all of this hit. So historically high relative to pretty much every period, even 2000, which was the peak. Didn't quite hit 2000 on all of the metrics, but we did on a lot of them. You can see from this chart, this looks at several different methods that are commonly used to determine valuations of the market. And pretty much in every one of them, we're in at least top 6% of all time. Some of them top 1%. The second horseman that I think is going to have a material impact on the future is going to be debt. We're at a level of debt as a percentage of our economy or gross domestic product that we've just never seen. It peaked in 2008 at 350%, and I think right now we're at about 325%. That's before, the Fed came in with a couple $1 trillion of stimulus in there. So, that is like anything. It just starts to weigh on your financial spreadsheets over time. You can go a long time with accumulating debt. And again, remember, debt is pulling future consumption to the present. So you can go a long time with debt, but then it eventually becomes unmanageable. What I talked about before was an Austrian economist, Hyman Minsky, talked. Essentially, you have debt that you can cover the principal and interest from the influx of cash. Then you have debt that you can only cover the interest payments, and then you have what he calls Ponzi debt, where you can't even cover the interest payments. So when you get to a certain point of so much debt, it all becomes Ponzi debt, and you just can't maintain it. And that's when you get these levels, that's what you have to worry about. And debt ends up being deflationary when it gets to be too much of a burden, because there's no good options at that point. You either default on the debt, which then hurts your creditors and hurts the economy. You either have to cut your spending to pay for the debt. So here again, the economy is going to be hurt. Or third, you sell assets to cover the debt. And again, when everyone's trying to sell assets at once, you have asset deflation. The third thing that I think is going to have a huge impact going forward is just the demographic profile of the U.S. and really a lot of countries. Italy's already kind of there. Japan's very close. And then China's not far behind either, with their one-child policy that they had through the 80s and 90s. They have a very old workforce. And we're not too far behind with the baby boomers. So the big impact is we have a massive amount of unfunded liabilities. When you look at Social Security, Medicare, state pensions, we're talking trillions of dollars of unfunded liabilities. And it's going to get to the point where it's just going to overwhelm our entire federal spending. The federal government, most of it's going to end up just going to things that you would think that they would be doing. I mean, defense, some of the regulatory agencies, things like that, they just technically won't have the money to fund those if they're going to pay for Social Security, Medicare, and some of the other things. And then you talk about the net interest that we're going to have to pay. Even with rates as low as they are, when you build up so much debt, that the interest payments that you have to make are just massive. So that's the third thing. And then the fourth one I've talked about is the US dollar getting stronger, because the dollar is the world's reserve currency. So the world transacts in US dollars. About 70% of all transactions internationally are done in US dollars. And the thing is, when you look historically, when the dollar gets stronger, it's deflationary here in the US, can be inflationary in other countries, because they have to convert their currency, which is usually weakening relative to the dollar, into dollars. And that means it takes more of their dollars to convert. But it kind of wreaks havoc in the world. I've shown this graph a couple times. So it's definitely a battle right now going to be between deflation and inflation. For the past, really since the early 80s, we've had a pretty optimal situation where we haven't had massive inflation, and we haven't had, outside of the short periods, deflation, outside of the recessions that we've had. So we've had kind of a disinflation and sort of a Goldilocks, mild between 1.5% and 3% inflation, and still getting some decent overall economic growth. So I think those days are going to be gone, at least for a while. And I think what we'll see is a deflationary environment right now as the world adjusts. All those four horsemen are kind of coming into play at the same time we throw the virus on top of it. The virus was kind of the pin into the bubble. But because of the massive amount of work that the federal central banks are doing around the world, eventually when we start to grow again, when we start to get the economy rolling, when we get the velocity of money up, again, the velocity of money, I've shown that graph a couple of times, it's at a historic low. All that means is how fast does your dollar that you spend get all the way through the economy? How's it cycle through? How quickly is it moving? Once you give it to the one vendor, how quickly they buy something else, and so on and so forth. So as we move through this and we get to the point where velocity money picks up, economy stabilizes, we've had such an influx of stimulus from central banks that I'm afraid they're not going to pull it out nearly as fast as what they should. And we're going to start to see some real inflation. And, nobody knows exactly, but I wouldn't be surprised to see another kind of 1970s situation, honestly. So you look, the markets have rallied up pretty good, stock markets, and you say, well, we're just getting through this thing. Is it going to be a V-shaped recovery? We get sharp downturn, way up. The thing you have to remember, we really haven't started to see the after effects of that initial drop. Again, we have 15% of the population at a minimum is unemployed. We had another 2.4 million just this week with new claims. So we're going to be pushing up easily 25%. Big drop in retail sales, worst ever. They're talking about a 48% drop in this quarter's GDP relative to last year. Industrial production down to a 100-year low. We have 30 million rent and credit cards have been defaulted on so far. 9% of mortgages have all of a sudden gone into forbearance. So, and that's just getting started. We haven't started to see all of the small businesses actually give up yet, but they're close. A lot of them are starting the process to do that, which is also going to have an effect on commercial real estate. So we're going to see lots of empty spaces in commercial real estate. Never mind the fact that we were already starting to see a little bit of that with Amazon and a lot of online retailers taking space. So we're going to see a lot more of that. So then when they start to go, you're going to have defaults from the people who own that real estate. And then, of course, you get to the individual level. If this unemployment lasts for any period of time, you'll have more credit cards go in default. You have more rent payments not being made. You have more mortgages not. So we're just getting into the solvency crisis here. And while the Fed and other central banks certainly have been quick this time to throw money out at it, it usually is a reaction to what's going on. So they're going to wait for things to get bad before they step back in. So it's probably going to be a lot of yo-yoing, but the general trend is going to pretty much be, I think, downwards. And this is something I showed it last week. This gives you just an idea historically between the drawdown of the stock market and the duration of the recession. So if you look at this, if we do have, okay, a 5-month recession, well, then maybe we are right where we should be with the markets, between 10 and 20% down would kind of be where you think we'd be. We're now about 13%. So, maybe we have had the worst of it, if that's the case. But if this thing goes on, as you get past a year, you start to see that the drawdowns, usually you're lucky if you can avoid a 40 or 50% drawdown in that kind of situation. And this is a deep, deep recession relative to others, with 2007, 2008 really having less than 7% GDP decline. And so the market lose 56%. The other thing, I showed this as well last week, just kind of giving you an idea of the maximum GDP decline and what do you usually see for the maximum S&P 500 drawdown. So obviously, as you would expect, the deeper the GDP decline, the worse the stock market's going to do. So where we had recessions where maybe a 1 or 2% decline, something like 1990, the one that destroyed George Bush's presidential hopes and put in Bill Clinton, it was really mild. It was about 1.5% decline in GDP and about a 20% decline in the markets. And then you have some others that, when you get up to 4, 5, 6% decline in GDP, you're looking easily at 40 to 50% decline in stock market valuations. So last week I said, what is probably going to work in this environment right now? So if we continue to have kind of a deflation, what's going to do well? And long-dated treasuries tend to do very well in deflationary environments. So you're locking in at today's interest rates. And even though today's interest rates are 1% or less, it's not the yield that gives you a bigger return. It's the capital appreciation. So as yields continue to come down in the deflationary environment, the bonds themselves actually appreciate in value. So that's why treasuries tend to do well. And you also want high grade bonds. So treasuries, you don't want to be in junk bonds or lower quality company bonds. Value stocks, although they haven't done very well yet, usually in these situations we get, value is sort of a low price to earnings, a higher dividend, reliable cash flows, good earnings, very defensive sectors, usually consumer staples. So, Procter & Gamble, Colgate's, Kimberly-Clark, which makes toilet paper, cigarette companies, things like that. And also utilities and healthcare a little. You can see I've listed those as sectors that usually do pretty well. But value can also be companies that have just been beaten up, or just sectors that haven't been reviewed very often or fondly by the market. And we're at a point right now where value is reaching levels it hasn't reached since the year 2000. So when everybody was in tech back then, value was ignored, and we're going to kind of have that same valuation right now. So, everything's cyclical, so I kind of think value stocks would be a good place to be. Gold's always going to be a nice place to be. And then anything US dollar denominated is going to do better than foreign currencies. And if you have the guts to step into the currency markets investing, the US dollar will probably be a pretty good place to go. So that's a short term, I think, deflationary. What I wanted to kind of just hit on today is more the inflationary part. So why do I think it's going to be inflationary when right now we have essentially a very deep recession followed by some deflationary structural issues, the four horsemen? Well, it's because the central banks are coming in at such a rapid rate and just throwing so much money. Within a month, the Federal Reserve took their balance sheet from $4 trillion to $6.5 trillion. I mean, that's mind blowing how fast they did that. They went from $800 billion to $4 trillion in the '08 debacle, but it really kind of took a little while to get there. This was almost overnight. And like I said, I think they're fighting kind of a battle here. It's going to ebb and flow. Deflation will show back up. They're going to respond. It'll seem like it's gone and it'll show back up until we get through all of the imbalances that we have associated with this recession. So the balance sheet's only going to get bigger and bigger. I've heard things where, well, stock market goes down, they're going to start just buying stocks next. And, right now it was unprecedented that they started going and buying actual non-treasuries and buying direct junk bonds, low credit bonds. They did it through exchange traded funds. So I think it's going to be just unbelievable what they do. And the problem is they're not going to want to pull that away, because as soon as they do, it undermines the stock market and other asset classes. Every time they've tried to stop a quantitative easing, that's what's happened. So I think we're going to have a period where when we start to recover with a massive amount of assets that they put into this balance sheet, it's going to start to hit us. And this is another way to look at it. This is what they call M2. M2 is essentially everything you would think for money. It's going to be the cash that you have in your pockets. It's going to be your checking accounts, but it's also, that's M1. So your checking accounts and the cash that's in the economy overall is what they call M1. That's that measurement. M2 then adds some other quick cash or cash equivalents. So it's going to be savings accounts, CDs, money market mutual funds. That's considered part of M2. And you can see it's really spiked. And it spiked to the point where the last time it had this big of a move was in World War II. So M2 almost always leads to inflation of some sort. This is a graph showing you an overlay between inflation in the blue and the M2 or monetary money growth. And you can see, with the exception of this recent spike, we have had a good correlation between inflation and money growth. And I think at some point this will reconnect. And, when it does, we're going to see some serious inflation. So if we do, what kind of assets do you want? Well, it's going to be very different than the deflationary assets, as you can imagine. So rather than have long-term bonds, you want to move to short-term bonds. And the reason is, in inflationary environments, long-term bonds do very poorly. Again, it's not dealing with the interest rate that's paid on it. It's going to be the fact that when you have inflation, bond investors demand a higher interest rate so that they're getting a return above the rate of inflation. So as interest rates are going up, if you own a bond that's yielding 1% and all of a sudden the current yields for bonds is 4, 5, 6%, well, your bonds are going to lose value. You're going to have capital depreciation. So that's why you don't want to be in short-term bonds in that situation. TIPS, these are treasuries, but they're inflation-protected securities. They're going to do well. They obviously have a component so that as inflation ticks up, the principal that you invested also grows by that rate of inflation. Gold's going to do well. But I think Bitcoin will do very well, or something along those lines. You want to switch from defensive sectors. So you want to get out of the healthcare, utilities, and consumer staples and go to cyclicals. So you're going to want to go to the industrials because they'll tend to do well. You're going to want to go to probably consumer discretionary. That usually does very well. So a lot of the sectors in the economy that don't do well, miners are going to do very well. Commodities will do well. Basically anything that has any kind of scarce resources, So there's only so much gold in the world. There's only so much Bitcoin, only so much commodities. So when you have a fixed amount, but you have monetary depreciation, or the dollar's losing its value, those things that are scarce or more scarce are going to do quite well relative. You also want to look at currencies rather than the US dollar, which probably will do very poorly. You're going to want to look at things that are commodity producing currencies. So the Australian dollar, especially compared to the Japanese yen, Japan has to import everything. So they don't have huge amounts of commodities. So they have to bring it all in. So they're going to be hurting as commodities tend to appreciate in price. So that kind of play would work well. Growth stocks are going to do well. The tech should do very well in that situation. Emerging markets, which are very commodity-based economies, they'll do very well. So that's sort of the general secondary trend. This could be, I've had people ask me, when's that going to happen? Well, I wish I knew exactly, but it could be a couple, 2-3 years at least, at a minimum, before we start to see this. And it also comes down to how well the Fed can delay what's going on now. If the Fed continues to come in with tons and tons of money, they can delay the inevitable, stretch it out longer. Doesn't mean it goes away. I make the argument that 2008 was never actually fixed. They came in with so much money that we never got debt down to a reasonable level. We never really got rid of all the bad assets. They were able to cover it up for a while, and it just sort of continued and then regrew. So we could have a situation where the inflation doesn't really kick in for a while. But the problem is, if we have any real type of growth, the amount of stimulus this time is so much bigger that I think it's going to probably play out faster than what people expect. Again, scarcity of assets is what's going to be good in an inflationary environment. This kind of just gives you a graph of the total financial assets of stocks and bonds in billions, 266 in billions, so $266 trillion. And then cash in general is almost 40 trillion. Gold that we have above ground, so non-mine, is about 10 trillion right now. And then the market cap for Bitcoin is 186 billion. So that's kind of why I look at gold and Bitcoin as something that could do very well as a store of value. That's the key phrase, store of value. Real quick on gold, I've talked about it before. I'm not call people gold bugs. I'm not a gold bug, and I don't think you should put all your money in gold, but you're going to have some of it. There's so many financial planners that just laugh at gold. They don't think that you should have any of it. Warren Buffett always talks about why he never invests in gold. He goes, it does nothing for you, it produces nothing. And that's absolutely true. Gold is not there to create new jobs or new industries or new products. It's a store of value. It's something that's finite in supply. And when you have inflationary, or you have a dollar that's losing value, that's what you want. You want asset classes that are going to be seen as that. And let's face it, gold has been used as the backstop for the financial system for 400, 500 years easily. So this gives you kind of a graph showing you the supply of money and the price of gold, what it does. So you can clearly see, as we're injecting more M1 and M2 and all that gold's going to track with it. And it's not a great investment. It's just it's keeping the value, your purchasing power, store of value. And gold so far this year has done very well in US dollars, but especially in some of the other currencies that have depreciated in value relative to the dollar. So gold is doing quite well right now. So it's already kind of serving its purpose, but I think it'll get even more important as all of the currencies are devalued even further. And then if you want to look historically, if you go back to all the way to the 30s, the Great Depression, gold relative to the stock market, it did very well at that point. Starting in 32, when they made owning gold illegal and revalued the dollar relative to gold, you had massive moves in the price up of gold. And then you had that also in the 70s and early 80s. So the price of gold exploded back then. it was a few years after Nixon took us off the gold standard and we continued to run massive deficits. And then all of a sudden the price of gold just took off as the value of the dollar and inflation kicked in. So, and that also is a good example of how it takes a few years for this to hit. So we have mass, in the 70s, really late 60s with Johnson, he had his guns and butter. He had the Great Society plus the Vietnam War that continued on with Nixon. And then it got to the point where Nixon had to take us off the gold standard because he couldn't back the US dollar to gold. Once he did that, and we continued with the deficits, it took another 7 or 8 years before it really had its impact as far as inflation. Well, not really. It was probably 3 or 4 years. So we're closed till noon. I'm sorry, we're not open yet. Oh, I'll be right back. Yeah, we're actually not open. I'm doing a presentation.
Oh, okay.
Are you just dropping something off? Or?
Yeah, doing my drop off my hat.
Okay. Yeah, I'll just take that for you if that's okay.
Yeah, we normally get it here if you have all my contact information already.
Okay, perfect.
Sorry about interrupting.
Oh, no worries, no worries. Sorry about that. I'm the only one in the office. Okay, so anyway, what you're going to get at that point in the late 70s, early 80s, you had dollar relative to the U.S. stock market at all-time highs, and right now it's really low relative to the stock market. So a lot of people look at gold and just say, "Hey, there's just a general trend here anyway." That could be a nice little tailwind for gold. So anyway, Bitcoin. Now, Bitcoin is something that it is difficult to understand, and I've been fighting with it since 2011. I've been reading a ton on it, and I've never pulled the trigger on it because there are some risks to it. But the more and more I read about it, the more and more I study it, I kind of think that if it's not Bitcoin, it's going to be something along those lines that eventually come in to play, because going all the way back to what I talked about, the Federal Reserve, this is the third Federal Reserve that we've had, the third central bank. And eventually every one of these things have failed for the same reason, that it's just been malfeasance on their part as far as managing the dollar, managing the currency. And we're getting awfully close to that. So if we have a situation where the dollar really starts to lose value, then we're probably going to see some move away from it, and people are going to want something that's going to be more of a finite situation. And then that'll last for hopefully quite a few years. And then, of course, the government will, because if you have a finite currency, the government can't spend as much. They have to be a little bit more fiscally prudent. So at some point, even after we go to a finite currency, they'll try to get away from that because they're handcuffed. They actually have to act like adults. So what is Bitcoin? Most people are just wondering, well, it's a digital currency. It's basically a monetary system. And I think a lot of the mistrust in it starts out right off the top with who created it. And the name of the supposed person who created this, Satoshi Nakamoto. And they don't know who this person is or if it's a team of people or what. But basically, he created a system to develop this digital currency. And it wasn't the first digital currency that was created. There were several before that as well, but they just never, took hold. And I think the reason is Nakamoto, or whoever it is, created a set number of Bitcoins that could be produced. And also around that created a decentralized verification system. So it's called blockchain. We'll talk about that in a second. So this essentially what it does connects buyers and sellers through encryption keys. So it's no longer knowing the individual. It's no longer knowing your social security number. It's all based on these keys. Now that can be good and bad. It makes transactions anonymous. So that's good and bad. So if you're a crook, well, it's good for you because it's anonymous, but it's bad for society in general. But for you as an individual, a law-abiding citizen, it can be pretty good for you. You don't have the government knowing everything that you do, everything that you buy. everywhere that you're going. That's always good. And then when you put that on top of a finite supply, there's only going to be 21 million total Bitcoins. And so far, I think it's like 12 to 15 million have been mined. Mined is a phrase that they use. I'm not going to get too much into how it's created, but out there, there's 21 million total. And then over time, it's meant to be pulled out of the system or mined out into use for everyone. And again, what Bitcoin's going to be is it could be a store of value. There's a finite number there. And if it becomes something that is seen as an actual currency, then you've got a good store of value there. It's unalterable, can't be messed around like the US dollar. I mean, the Fed could go in Monday morning and print $3 trillion. You can't do that with Bitcoin. And then the blockchain is the way it makes it very secure. So what is the blockchain? You hear that. Now, whether cryptocurrencies do well, whether Bitcoin does well, whether it exists, the one thing that's going to maintain out of all this is the blockchain. The blockchain is just a way to verify transactions. So right now, when you go to use your credit card, let's say it's a Chase credit card, you put your card in the machine and it takes the data and goes back to Chase's database to verify it. There's one verification that that's you using your credit card. So it goes to their central database at Chase, and they have to verify that it is in fact you. So you have one, if you fool that one path, then somebody else can use your credit card. The other thing is when you have one central database, if I'm a hacker and I breach that one database, I've just reached nirvana. I'm in there. I've got all this information that I want. I have access to it. Same with, your bank accounts, everything like that. So, I mean, obviously there's backups to their database, things like that. But if I can pierce that one database wall, I'm in. I'm there. Whereas with blockchain, it's going to have a decentralized balance sheet, and everybody, like everybody listening to this and me, we can all download all of the transactions. It's completely open. And what happens is we would start to verify all of these transactions, and we get compensated for doing so. So now all of a sudden, if you're going to put your credit card into, the ATM machine or, the Target credit card reader, instead of it going to one database and being verified by Chase's database alone, there might be 10 or 15 verifications. And then also when that transaction takes place, all of the people that have downloaded all the transaction, all those spreadsheets, their spreadsheets get updated. So it's like it's almost impossible to hack, because you're going to have so much verification, so many more independent parties verifying that is in fact you using that credit card. It's also good for the banking because, again, they don't have to just breach one database. So even if they did, there's still others that are going to say this is an invalid transaction, and it's not going to get into all of the other databases and all of the transactional ledgers. So blockchain in general is going to be something that's I think truly revolutionary for the finance industry, ignoring the whole cryptocurrency. But what the blockchain does with Bitcoin is now it verifies the transaction. So, rather than me taking $1 and handing $1 to somebody, which could be forged, nobody knows. But with a Bitcoin, and when I hand that to somebody to purchase, it can be verified by numerous parties and then updated across all of the ledgers around the world. So it provides a lot more security, but it is anonymous. So there could be some money laundering and things along those lines. But that's the blockchain. So when you hear the blockchain, it's just, think of tons of nerds in their basement, verifying transactions. That's kind of what it is. That's what they're doing, but it provides a much higher level of security. So it's got a very good backing on it. And then you say, well, is Bitcoin going to be around? But there are downsides. The first one, I'll show you a graph here. It's just the volatility. I mean, it's unbelievable volatility right now. So working as an actual currency, it doesn't work right now. Yeah, you can't. Okay, if you're going to go buy a car tomorrow and you've got your Bitcoin lined up to pay for it. You wake up the next day, it could be down 20%. Now all of a sudden you can't buy your car. So it's not there as far as being a currency because it's extremely volatile, but it's extremely early in its stage. So that's volatility is natural in that. There have been exchanges that have been hacked. So, like right now, if you use TD Ameritrade, Charles Schwab, and you're transacting stocks, well, there's same exchanges for Bitcoin. So you transact in Bitcoin and other cryptocurrencies, and they have been hacked. And remember, there's no name to this. There's no, Joe Johnson on that account. It's all this encryption key. So if somebody gets your encryption key, that's theirs. So there's a risk there on that. That's one of the big downsides. Security is a huge issue. Yes, the blockchain does provide security for the transaction being valid. So it can provide so protection against fraud or some theft in that. But if somebody gets your key, they've got it. There are a couple examples. There was one exchange called Mt. Gox that lost 750,000 coins for clients. There's a Nice Hash lost 60 million. So there is a risk with that. I've read stories like people who had their encryption keys and then wrote it on paper and threw the paper out, and it's gone forever, and it would have been worth tons of money had they kept it. So there's risk with this. But again, that creates more scarcity in a way, which would be good for the store of value. The other thing is the government could just come out and say, hey, it's completely illegal to hold this. They haven't done that yet, and it seems like it's kind of down the train. I don't know if they could pull it back. The state of Wyoming has already gone as far as to create legal protections for people or holders of Bitcoin. And other states are starting to adopt that. So it's getting to the point where it might be a little bit too far down the tracks for them to pull it back, but they always could. And if it got to the point where it was causing the dollar to lose more value or infringing on the amount of spending that the government can do, hey, they could do that. The other thing is there are a lot of cryptos out there now. So when Bitcoin started to really gain traction, there's just a ton that have been developed. Nobody knows exactly which one might be the best. I mean, I think Bitcoin's it's sort of the marquee. The others are, in many cases, just people coming, software programmers trying to get rich, coming up with a new coin. But we'll see. Nobody knows. There's going to be some of these cryptos that are just backed by gold. So, rather than being a nefarious Bitcoin that's really not backed by anything, it's a finite supply, but there's nothing behind it necessarily. You might have a coin that's backed up by gold that you could exchange for an ounce or two of gold. So we'll see. Nobody knows exactly. This is the price volatility. So we do know that it is volatile. It started up in 2011, and at that point it was actually under $1 per Bitcoin. So if you'd have bought back then, you'd be quite wealthy right now, even a small investment. But you can kind of see it really exploded in 2017, went from about $1,000 per Bitcoin to up to, what was it? I think it reached up to almost 19,000 within a year. I mean, that was clearly speculative fervor. And then it pulled way back, got all the way back down to $3,000 per Bitcoin by 2019. So that's a massive loss. Think if you got caught in that speculative fervor and came in after it hit 15,000, 16, 17,000, whatever, and then it basically drops down to 3,000. I mean, that's just a massive move. But then even after in 2019 hit 3,000, it got back up over 12,000 within a couple of years. And then it's been going back and forth. And right now it's about 9,100 per Bitcoin. So this is extremely volatile. If it's something that you go into, you're going to have to realize that there's a ton of volatility. You'd have to invest with this. And, you always talk about being a long-term investor. That's what you'd have to be looking at with Bitcoin. But it doesn't take a lot of Bitcoin to actually have a material impact on a traditional portfolio. So again, looking listening to a lot of podcasts, talking to a lot of people. And in fact, I've got a really good interview on the Saving Yourself from Wall Street podcast with Matt Hogan at Bitwise. These are some graphs I'm going to show you from Bitwise Asset Management. And he's done, Matt was a guy I knew way back in this ETF days in the early 2000s. I got to know him because we were kind of both leaders with ETFs, speaking at conferences, and a very thoughtful guy. So he ended up moving from ETFs to Bitcoin or cryptocurrency. And when somebody who's very thoughtful and a kind of a thought leader in ETFs moves to a completely different asset class, I was like, I gotta pay attention here. So I've been digging in a ton on this, and this was something that he did, looking at what would the impact be on a traditional 60% stock, 40% bond portfolio, with just a minor allocation to Bitcoin. This shows from 1%, 2.5%, 5%, and then just the brown line is just the traditional portfolio. And this is from the 2014. So this is from when really you started to see Bitcoin go up quite a bit. I think you saw it go from like 200 to 1,000 in 2014. And it also includes the collapse in 2017. So it's all the way up from, the whole year of 2017. You can see on this chart where it gets to 2018, you can see how things have gone up quite a bit, but then it pulls back because 2018, 2019 were horrible for crypto. But even then, in every situation, a portfolio with the ups of the Bitcoin up to 19,000 and then going down to 3,000, with all of that, you can still see that every portfolio with any allocation, even a 1%, ended up having a much better outcome than just the traditional 60-40 portfolio. Now, again, what do you always say? Past performance is not indicative of future performance. You always have to put that disclaimer in there. Who knows? Again, if the government says you can't use it, it could lose permanent value. And it could be very volatile. Nobody knows what really would happen. But so far, even with a massive decline from 19,000 to 3,000, it still provided value to investors, over this period. Okay, let's get this thing going. This is that chart, but basically in numbers. So you don't have to look at squiggly lines everywhere, but you can kind of see what the cumulative return is from that 2014 all the way through March of 2020. So the whole downturn. So the traditional 60-40 portfolio, the cumulative return was about 26%, but you can see what happened with the 1%, 2.5%, and 5% allocation to Bitcoin. And then you can see that on an annualized return basis. But the big things to look at, a Sharpe ratio, that is what it does is it takes your return and divides it by risk. So when you take a return divided by risk, that gives you what's Sharpe ratio. So the bigger the number, the better off you are as far as showing the amount of return you get per amount of risk you're taking. So you can see it improves the Sharpe ratio, and then the maximum drawdown is pretty comparable no matter what. So there's definitely a case to be made on both a risk and a reward for an allocation to Bitcoin. And then this just gets into a little bit about what's the optimal way to rebalance this thing. So if you buy some Bitcoin, you want, if it gets some gains, you want to sell it. If it's dropping, you want to buy a little bit more. So that's rebalancing, right? You're always kind of coming back to your original allocation. So if you have a 2.5% allocation, every so often you want to come back to 2.5% allocation. And it's kind of showing you that the optimal way to do it is actually just a yearly rebalance. That's the kind of tannish line there. So when you look at those things, it does very well in that situation. Quarterly rebalance is probably the second best. But you can also see, again, that the traditional portfolio just didn't do nearly as well as having that 2.5% allocation. So the 2.5% allocation, whether you didn't do any rebalance, a quarterly one, a monthly one, or an annual one, all provided better results in the traditional portfolio. But the optimal way to do it looked to be just a yearly rebalancing. And again, this is the numbers behind it, behind that confusing graph. Again, you can kind of see the cumulative return with the different, the annual rebalancing in that one produced really nice return, 8.5% annualized. And you can see Sharpe ratio was the best for that. So, if you're looking at Bitcoin, you might want to make sure you're doing at least an annual rebalance no matter what. So take that long-term focus. Know it's going to be volatile, but rebalance every year no matter what. So the next thing is, well, how much should I add? Because that's the $1 million question. And that's going to be awfully difficult to see. Now, this one shows you, as you probably expect, with the performance of Bitcoin over the time, the bigger the allocation to Bitcoin, the better the performance. That would make sense. Bitcoin has been, since 2011, the best performing asset class, bar none. So if you have the best asset class, more than likely in every situation, it's going to, the more you have of it, the better off you're going to do as far as your total portfolio. Again, past performance does not equal future performance. You always have to say that. So as far as how much you want to load it up, right? Just get as much as you can in there. This capped out at 10%, but you can kind of see the cumulative return for that end up really having a massive impact on a portfolio. This is looking at a 60-40 portfolio all the way at the far left of it, 0%, and then all the way up to a 10%. So you can see it's basically the more you had, the better off your return. But is that necessarily what you want to be doing? Sorry. Okay. Because it's not always about return. That's the problem. So many people only focus on the return. What ends up happening, you have to also look at the risk, because it's going to be volatile. So when you start to look at it from a risk and return standpoint, you can kind of start to see this measures standard deviation. So how volatile does the portfolio get by adding certain levels of Bitcoin? So again, it starts at the far left at 0% Bitcoin all the way up to 10%. And you can kind of see it's sort of a linear projection until you get to about 3% Bitcoin, and it starts to get a little bit exponential as far as the risk. So if you're going to go back to kind of a risk return, you want more return, but you also want to manage your risk. You're basically looking anywhere from probably 3 to 5% is the optimal risk return standpoint for it. And then this looks at also the maximum drawdown. So, right, what we want to look at again is when you're an investor, nobody likes the drawdowns. The downside, the losses on the downside, they've shown studies, people hate losses a lot more than they like winnings. So those down years are more painful than the up years are pleasurable. So it's going to be a balance between getting the return, but also managing risk. So we said it's between 3 to 5% for the standard deviation or general volatility. But here we're saying, okay, what's the drawdown? What's the maximum drawdown from that January 2014 through March of 2020? And so you can kind of see the Bitcoin allocation again from 0 up to 10%. And then the maximum drawdown effect on a 60-40 portfolio. And really, when you go from 0 and you start adding Bitcoin, you're actually reducing your drawdown. And you saw that in the first couple of graphs, that your risk dynamics, your Sharpe ratio was better with a little bit of allocation, even 1%, to Bitcoin. And this chart shows you that yes, even from a traditional 60-40 portfolio and 0% of Bitcoin, as you start to add Bitcoin, you start to get to a position where your drawdown is going to be less than the traditional 60-40 on its own. And that gets all the way to about 3.5%. So once you get to 3.5%, it starts to climb back up. So here again, about 3.5% is the optimal amount there, and then maybe up to about 4.5. At 4, anything above 4.5%, you now have about the same drawdown potential, at least historically, as a 60-40 portfolio would have performed. So if you add 4%, you could expect the same kind of downside. But if things were to repeat in any kind of fashion, the Bitcoin would hopefully add extra return with the same amount of risk. as you get up 5, 7, 10%, now you're getting to the point where your drawdown is going to be much higher because Bitcoin is a very volatile asset class. But if you can kind of keep it in that anywhere from that 1% to 3.5%, 4%, you actually start to see a situation where your maximum drawdown's less. So you don't have to add a lot here, at least with using historical Bitcoin data, to have a huge impact. And the thing is, Bitcoin has an extremely low or negative correlation to other asset classes. When you look at Bitcoin or other cryptos, it doesn't seem to move, and it doesn't track stocks. It doesn't track bonds. It's completely independent, which is why it has a pretty good risk return dynamics, even though you had a period where it went from 19,000 per Bitcoin down to 3,000, a massive loss like that, but you still had a good risk return dynamic to it. So as I look more and more to it, I start thinking maybe a small allocation for clients is probably going to be something might look to do. Again, past performance is not indicative of future performance. Nobody knows exactly. But if we have a situation where the Fed just continues on its path of trying to keep things, moving in the fashion that it is, just pumping money in, and we have the growth of money, we're going to get inflation. We're going to probably have a situation where the trust in the dollar down the road could completely go away. So that's basically, why I've been talking about the Bitcoin and things along those lines and looking at it. I just wanted to dig a little bit deeper in that. And I do highly recommend, if you want to listen to the podcast I did with Matt Hogan, he gets into it even deeper as far as the correlation to other asset classes. I tried to ask him some tough questions like, how do you know the government's not going to ban it? How do you, why does the price have to go up at all if it's going to be a currency? Stuff like that. Has some pretty good answers. And I'm going to probably try to have him on a video too. He's got a lot of really good stuff. And there's some other really smart Bitcoin. When you get into studying Bitcoin, you've got to really be careful. You want to look at people who are in the finance industry that have been doing it for a long time. And Bitcoin's got a lot of its, libertarian folks that are just focused on that. And I'm very libertarian politically, but, they're just looking at sort of an anti-government approach to it. I don't want to look at it that way. I want to look at it as an investment. And then you have millennials who, they're kind of a fight to power sort of thing too, that they think it'll take over, or they're such programmers. They like the fact that you program this stuff, and they're creating their own cryptos, and so you have to be careful where you're looking for your information. But there's a lot of very good hedge fund managers, there's a lot of very good researchers, academic researchers, financial researchers that are really digging in there, and there's a lot of information out there. So yeah, let's just open up to some questions. Question on holding actual gold bars. Okay, so yeah, holding gold bars, and the question is, should you hold actual gold bars, gold coins, or should you invest in funds that hold gold? So it's a different dynamic. It's always good. You can make the argument it's good to have the gold on hand, right? If things go bad with the currency, things along those lines, it's nice to have it in your hands. It's also, you've got control of it. The risk is just like that Bitcoin could be gone. If somebody stole your encryption key, it's the same with gold. Somebody steals your gold, there's no way to validate that's your gold and not the person who stole it. So there's risk to that. So storing gold has always been an issue. And back in the 30s, when FDR made holding gold illegal, if you had it in a safe deposit box at a bank, they had structured a law so that when you went to your safe deposit box, the bank representative would stand there with you. And if you had gold in there, they were instructed to take that gold. Now, did they do it? I don't know. But that's the instructions there. So you also have to be careful. Another really good interview, I'm about to put out another podcast. I talked to one of the fund managers at Aberdeen Investments who has a gold ETF. And we talked about that. How do you know you're really getting gold when you invest in these ETFs? And there's a an ETF that has gold in it. The ticker symbol is GOD. It's a State Street Gold Trust. It's got $55 billion in its trust. But the problem is when you have that much, where you're supposed to have that much gold, it's not just one custodian holding it. The custodian hires out to different custodians who are supposed to have it in the vault and supposed to audit it. So you have a lot more people. And there's been all kinds of talk that some of these minor custodians, what they do is they just buy futures contracts of gold. So commodities, again, function on a contract, a futures contract. So I could buy a futures contract for gold, soybeans, wheat, oil, and then that would be delivered to me when my contract is up. So if I bought a 6-month contract for gold, I know, okay, 6 months, whoever sold me that contract has to deliver that gold to me. Well, what they're saying is a lot of the bigger gold ETFs might not actually have all that gold in the vaults. They're just using the options and the futures contracts, thinking that, well, if I ever needed it, if I ever run on it, or if I liquidate it or something like that, I could get it from my contracts, which doesn't mean necessarily you could, at least not at the price that they'd want to get it at. So like the Aberdeen, they control their own vaults. They've got about 1 billion in assets under management for gold. So they control the vaults. They audit them. They know that the gold is sitting there. So I'm okay investing in that kind of situation. I don't know if you could use a gold bar in real life. That's just too big. You couldn't transact normally. I mean, if you wanted to have some precious metals for transaction, like things really go to hell in a handbasket, I'd probably get silver coins. I think that would be the better option. You could store those easily. They're not as expensive. And, if you come to me to buy some food or something, you probably could get a bag of groceries for a silver coin. But if you brought a block of gold, you'd probably own the store if things got bad enough. So you got to really look at the underlying fund, and there are some good funds out there. Again, going back to Aberdeen, there's another one called Granite Shares. The cost to store the gold is like 0.15% per year, so it's not much of a cost, and it's being fully audited, fully secured. So that's typically how I would buy gold. Another question on Bitcoin having a big run in price due to the halving. What is that? Is that similar to a stock split? Okay, so it's a great question, and we're getting into the weeds a little bit. So I mentioned that Bitcoin is mined, right? There's only that 21 million Bitcoins, and they're going to come out onto the market over time. We have 12 to 15 million that have been mined so far. They called it mined just based on the gold, when you do mining for gold. So you have all of these people who are essentially trying to mine the Bitcoin. And how do they mine the Bitcoin? Well, it's basically a very elaborate mathematical equation. You have to solve these equations, and then the Bitcoin will show up. So you have all these miners are racing to figure out these calculations. And when Bitcoin first came out, the calculation was very simple. Probably you and I could figure it out just using our basic calculus that we took. But now the algorithms are getting more and more complex. So it's harder to get the money out of there, harder to get the Bitcoin out. And it's going to get harder continually over time, just based on the algorithms. But the way it works is if you're a miner in gold, if you're out there back in the 1840s and you're in California, Colorado, and you've got your pickaxe and you're in the creek with with your strainers and all that, and you find the gold, well, the bigger chunks you get, the more money you made. And that's kind of how it was with Bitcoin too. It first started off that they would pay a certain amount. You get so many Bitcoins when you found the gold, when you made a gold finding or a Bitcoin finding. So when you're mining Bitcoin, you have a find, and then you would get a certain amount in Bitcoin yourself. I think so. Every 4 years, roughly, the amount that you get paid for mining Bitcoin chops in half. So I think with the recent halving, they now get 12.5 Bitcoins for every, let's say, gold find or Bitcoin find. So they get 12.5, but 4 years ago it was 25. And then 4 years before that, it was 50. So there was a lot more money to be made with Bitcoin early on, although it wasn't as high a price. So the thing is, as you make it so that there's there's fewer miners out there. I mean, if you go from 12.5 Bitcoin per find, and then the next halving will take that down to, 6 roughly, it gets harder and harder to make these finds. So in order to entice it, if the amount of Bitcoin they get goes down, well, then the price typically is going to go up. Otherwise, people will just stop doing it if it gets to the point where the cost outweighs the gain. So usually what you see during a halving is the price ends up going up in order to compensate the harder work that the miners are going to have to do to get the Bitcoin out. So we had to go just recently, the halving, and it did jump from there. But what I've been reading is it hasn't reduced the number of miners yet. So that's when they think it'll, when some of these folks give up and they go out of business, because it does take a lot of energy, takes a lot of time, lots of computational power. When that happens, then the price might go up even more. Ultimately, what you have to say is, do you trust the financial system? I mean, do you trust that we're not going to see massive inflation? Do you feel like for at least a portion of your portfolio, you're going to need something that has a finite supply? And that's my point. I don't think we're there yet. I still think we have massive deflation. I think the dollar is still going to do well. So having dollar-denominated assets, whether it's stocks or bonds, are going to do really well. And even in inflation, a lot of stocks are going to do well. But you're going to see in inflation, other dollar-denominated assets aren't going to do well. So you want things that are going to have finite supply, commodities, gold, and probably Bitcoin. So I always have a little allocation to commodities and gold for clients, but I think it's going to end up making a little bit bigger portion of the portfolio once we start to see, the velocity money pick up, the economy start to go. I think I'm going to add more and more to it. Just because I don't really trust the Federal Reserve. I don't, the amount of money they're putting in to try to stop, to put their finger in the dike, that they're going to have all their fingers out pretty soon. They're going to have so much out there, and there's no way that they'll ever be able to take it away. And that's going to cause some inflation. So let's see, are there any other questions? Doesn't look like it. If you have any other questions, go ahead and shoot them to me. Kind of hitting that hour mark, which is where I usually like to let you guys get on with your weekend. I'm not going to be doing one next weekend. I am traveling next weekend. So with all my Coast Guard buddies, we get together once a year, and we'd set this a while. We're going to Nashville. Fortunately, Tennessee has kind of opened up, I think at least enough to the point where, we can go out to dinner or something like that. One other quick question here. So is Bitcoin the best cryptocurrency to invest in? At this point, I say yes. It is. It's the bedrock. It's the, it's sort of the Amazon of cryptocurrencies. The rest of them so far are mostly just programmers trying to come in and create a money maker. But so far it seems to be the best currency that will be there. It's the one that's probably the deepest. It's probably it's most recognizable. So I think right now that's without a doubt the best one to look at. Yeah, Ethereum's another one to look at if we're really going to go away from the dollar and have a transactional cryptocurrency, because it doesn't take the computational power. Eventually, if that were to happen, I think we'll have Bitcoin as the base, and then something above that will be the day-to-day transactions. So I got a question about it. One client has her son started doing, I assume, Bitcoin mining. Is that what it was? The process is, I'm not sure the question. looks like they're asking me to explain the process of Bitcoin. I mean, we could probably do something on that. I'll probably do interviews with people that really know it much better than I do. You can explain it in a very coherent manner. That's what I'll try to do, is to give you more information. Before I put this in the client portfolios, I want to make sure clients are getting a lot of information on it. So, puts and calls. Oh, they're doing options. Okay. Yeah, we could talk about options. So the question is, can we do something on just options for stocks? So put is when you think the price of the assets going down, calls when you think prices are going up. Options can be used either as speculation or as insurance. When it's used as insurance, they're very good, but when they're used as speculation, they're dangerous. If you ever heard of people losing a lot of money in options, in the options markets, because they started speculating. But I'll bring that up, and that's a great topic to bring up for the future. Absolutely. So anyway, think about Bitcoin, thinking about gold, think about finite resources. At some point, I think that's going to have to make up a bigger portion of your portfolio, just because currencies, whether it's US dollar, the euro, the Japanese yen, they're just going to start to lose value. And, it's going to hurt things like the bond market severely. It'll really hurt bonds. It'll probably hurt some real estate too. But, if we have the Federal Reserve and central banks just undertaking these, history is just not on their side. Like I said, this is our third central bank, and the other two went bye-bye for the same reason that this one looks to be. They just do too much, and it gets out of control for them. So hopefully this was useful. And again, I hope you guys have a great weekend. If you have any other questions, please just send them to me via email. And I do highly recommend you go to savingyourselfromwallstreet.com. I've got podcasts, which are like radio shows. I've got videos. These videos are there. But the podcast, especially the one on Bitcoin with Matt Hogan, is a really good one. So have a great weekend.